Welcome. This is the first episode in Troutwood's speaker series. Today's guest, Jonathan Brelsford, is the Chief Investment Officer of the Pittsburgh Foundation. I'll let Jonathan have the honor of telling you more about the Pittsburgh Foundation, their mission, the organization. I'll just preface his introduction by saying it is a fantastic organization doing fantastic work with a fantastic team. During this episode, we are going to be unwrapping the institutional investment model and trying to bridge that conversation to choices that we as individuals make. Jonathan, welcome to Troutwood Live.
Thanks for having me, Gene. It's nice to be here.
The pleasure is ours, and I would love to give you the honor of a short introduction. Tell us a little bit about yourself.
Sure. So I'm the Senior Vice President of Finance and Investments at the Pittsburgh Foundation. The Pittsburgh Foundation is a community foundation, which is different than a lot of foundations that you might be familiar with. So those are typically private foundations. As a community foundation, we're a public charity, and we actually represent over 2,400 families that have established funds with us in our over 75-year history. Actually, we're in our 76th year, being founded in 1945. So those funds can act a lot like a private foundation. And as such, the underlying investments of those funds is really what I oversee, and me and the team here oversee. So they're really driven by our donors. We actually have 80 different portfolios. I like to say we operate a lot of the ways a asset manager might operate, right? So those 80 different accounts or portfolios represent these 2,400 charitable funds that have been established here.
When you say 2,400 charitable funds, is that individuals like myself who could set up a charity or support a cause that I'm passionate about? Absolutely.
So the funds themselves really range. They range from, here's our money that we want you to decide what the Pittsburgh community needs, and it's not just Pittsburgh, it's really southwestern Pennsylvania, what the community needs. And then we have staff that goes out and finds what that need is and makes grants into the community. Or it can be something that is where you as a donor stay involved with the fund and really help us determine how to spend that more, or I should say grant that money into the community. And it can be all over the world. We've actually had individuals that started a fund that helped fund orphanages in Korea, or education programs in India. Our focus really is around the nonprofit community in Pittsburgh, though, and that's really what we're set up to work with.
So there are three dots to connect, it sounds like: the charitable giving,
yep,
the investment of those assets, and then the social cause that those investments or assets are directed to help.
That's correct. Yeah.
And I'm not sure if you ever answer this question, is there a favorite or a near and dear charitable cause, maybe one that has a long history with the Pittsburgh Foundation, or one that makes you smile when you think about it?
Yeah. So the one because we're about perpetuity, and this is what I like to bring up when I'm talking to donors about how focused we are on that. There's a fund here called the Milk Fund. It was actually started prior to the founding of the foundation, and came to us as essentially we became the administrators of it. The Milk Fund was designed to provide milk for orphaned children. And there are no more orphanages anymore. I mean, it's just not a part of our society, but there are homeless children. So what we have repurposed this fund towards is about supporting homeless children. So it's been it's kind of near and dear to my heart as a parent of 4 kids, knowing that we have funds that are set up to help support homeless youth. And that can come in a lot of different contexts. A lot of people that you would not consider, you personally might not consider homeless, but in actuality are at risk that can be affected by this. So it's a pretty neat fund.
That's very neat. The word perpetuity is important as well for everyone listening. That means to last long past any one of us, to last forever, essentially.
That is absolutely correct. It gives us a long time horizon to work with as an investor.
And Jonathan, you know this, but to everyone listening, there's a small group of college and high school students that are listening and following along live now. They'll be asking questions for 17, 18, 22, 25-year-old. Perpetuity, it's not a 100% accurate word to use, but it's okay to think in that context at that young of an age.
Absolutely. And certainly I would myself, when the way I think about perpetuity is past my lifetime at this point. But as someone who is younger, certainly a 70-year time horizon is as close to perpetuity as any of us can get, right?
Well, here, so not only is the Pittsburgh Foundation set up in terms of investing the assets for perpetuity, the individuals, the donors, are already thinking that way to be reaching out and saying the milk fund matters to me. I'd like to, make my assets last in perpetuity.
Yeah, I mean, we take a consultative approach here. So a lot of times people are thinking more about that immediate need that they want to fulfill, and we bring them along towards that perpetual or endowment approach because we think the community there is need now and there is need in the future. It will just be a different need, right?
Mm-hmm. We're going to unwrap and back into that model. What does a day look like? What are your responsibilities for the Pittsburgh Foundation? Help our listeners understand, or just walk us through a day, a week, a month.
Sure. So it can be a relatively straightforward day. The markets are, I actually typically don't pay that close attention to markets because of our time horizon. So from a day-to-day basis, I'm not as concerned about it.
Can I make fireworks come off on the screen right now for anyone listening to that statement?
So, but never, obviously I do pay attention on some level. I need to understand what's influencing our returns and what our managers, what I can expect out of our managers. So typically in a day-to-day, it'll start with an internal meeting where we might be discussing, as it did this morning, the investment office, we're talking about the next investment committee meeting, which is happening at the end of this month. So we're discussing the agenda for that meeting, what managers, if any, we might be proposing to the committee and want to discuss, where they sit, if there's any changes to a portfolio. So one of the things that is actually coming forward at this coming committee is we have a new portfolio we're going to be proposing, and that requires its own investment policy statement. That portfolio is somewhat unique because it's going to have, it'll be all equity, because we have donors that have a desire and have a higher risk tolerance than we might otherwise allow. So we're putting this out there. This really is a genesis, or has its genesis in conversations we have with our development donor services staff. So because we are a nonprofit, we are always, and we need to raise money from the community to demonstrate our continued community support. So we're talking to them about what are the needs of our donor, what are they looking for? And that can also be one of the questions we have is how do we solve for those needs and those questions that are coming up. And then the other part of my day really is spent discussing with investment managers, either investment managers that we have in the portfolio. So we are regularly touching base with them. We have actually over 60 managers that we work with in our primary portfolio. Just to be clear, we oversee 80 portfolios, but there are currently 4, soon to be 5, that we manage internal to the foundation, meaning we select the investment managers for those portfolios. and the specific mandates that were given. The remaining 75 are managed outside. We've delegated authority for the whole portfolio to local investment advisors, or we also work closely with the local trust departments of BNY Mellon and PNC.
Jonathan, when you say your managers, to just put some context around that, if I'm an individual or a student, that would be like me going to Vanguard and buying a mutual fund. If I buy an S&P mutual fund or a growth mutual fund, that'd be my manager.
Correct. Yeah. So we have in some of our portfolios, we utilize Vanguard primarily because of their fee sensitivity, but we also utilize managers from all over the globe. So,
boy, that's neat. To shape the team that you have working with you, how big is your investment staff? And then also, given that broader goal, how big is the entire Pittsburgh Foundation staff?
Yeah, so the entire staff of the foundation. So I'm gonna expand that a little because the Pittsburgh Foundation is actually has a number of related organizations called supporting organizations. So we have the Pittsburgh Foundation proper. We also have supporting organizations. One, the Forbes Funds actually works very closely with the nonprofit community around what their needs are and seeks to build capacity or build expertise within those nonprofits. We also have another one called Neighborhood Allies, which does economic development in the community. And then one that maybe some of your listeners or watchers of this webcast really know would be the Pittsburgh Promise.
Great organization. Yep.
So I was actually fortunate enough to be here at the foundation back in 2008 when the Pittsburgh Promise first kicked off and they were looking for a home. And so we actually worked very closely with the Pittsburgh Public School District and UPMC. I don't know how many people know, but the initial gift to found the Pittsburgh Promise actually came from the teachers union of the Pittsburgh Public School District.
I absolutely never knew that.
Now, obviously, the largest gift, the largest commitment came from UPMC, and that we're extraordinarily thankful to them for that gift to the community. But yeah, it was a pretty neat, ambitious goal. So those are the supporting organizations. The staff of the foundation itself, though, or in total, including our supporting organizations, is about 80 people. The staff of the foundation is just over 50. And then we have the investment staff really is a meager 4. And I say meager, and that's because we actually oversee $1.2 billion in invested assets.
Wow.
And those assets are in those 80 portfolios that I spoke of. The largest portfolio is the one that we spend a lot of our time on. We call the Legacy Fund, is for over 400, well, actually close to 400 million. We just made our distribution at the beginning of the year to drop it below 400 million. So we're working our way back there.
Jonathan, to frame how investing works, and I'll again throw this into the mind of a 22-year-old who maybe doesn't invest but is thinking of it. What was the size? You mentioned 1.2 billion. What was the size when you joined the foundation?
Yeah, so I joined the foundation in 2004. But when I actually started working with in the investment side of the business, it was 2007, and the size of our invested assets at that time were just under 500 million. And I say that
investment growth and then the donor.
Yeah. So I bring that up because the very next year, 2008, saw the worst drawdown that the foundation has experienced, that I've experienced.
We lost 38% stock market plus.
Yeah, our total assets dropped by 30% that year. So we were down around 400. Well, actually, the total assets were closer to 400 million. We actually the nadir of our assets was on March 9th, which occurred. Or I should say, which brought us to about $390 million in invested assets. So that's when I, the power of the investing of the past 12 years, almost 13 years, or 12 years has been pretty significant.
I would be remiss not to ask what your emotions were joining in 2007, then experiencing 2008 immediately.
So, I'd actually been working at Mellon on a credit desk, looking at the money market, I should say, lending to money market investors. So, or providers. So I was well aware of the potential stress that could happen in what actually is underpinning cash, which are these short duration loans. So it actually didn't surprise me. We'd been warned about it, and I'd had a number of discussions with our staff and with our investment consultant at the time. So it was certainly concerning, but I felt with a lot of the efforts that were put in place really at the time. I mean, if you look back at September 2008, I was not as concerned. I was initially concerned in probably the second or third week of September, but when it didn't break, like the monetary system didn't break at that point, I felt pretty sure we were going to make it out. So it was really more at that time. I tracked certainly, what the losses were on a weekly basis, but most of what I was trying to convince everybody of is, though the market was dropping in value, those underlying companies, we actually were still receiving donations. We were investing assets at much better valuations at that time. I didn't see the market going to zero. People were still going to buy cars. People were still going to build houses. You're going to go to the grocery store and buy food. Those things are all going to happen. And under the companies that are involved in that, you're just getting an opportunity to buy them at a better value. Same thing when I look back at March of this past year, when we saw the stock market crater. We take a very disciplined approach. We try to take a very disciplined approach to rebalancing our portfolio. So when we saw the opportunity, we actually put money to work a little bit early, but I mean early by about less than a week from the bottom of the stock market at that time. So
there are two important statements you made. We stuck with it. So you watched a $500 million portfolio drop to just below $400 million.
Yep.
And now it's 1.2 billion because you stuck with it.
Absolutely. Yeah. I mean, that just teaches you to be disciplined in the face of pretty dramatic losses, right? I mean, the other aspect I'll just bring up is we have our spending policy, which is really what our goal is. So we have a goal of 5% plus inflation. So those two components, that 5% represents our spending policy. That's what we distribute from each fund generally every year. But the balance that it's calculated upon is based on a 3-year rolling average. So we go back 3 years, and it's actually calculated as of September 30th of the prior year. So when we did the calculation for 2021, what the grants were going to be and what essentially our budget for the coming year was based on, we looked at the prior 36 months balances of each fund, calculated that average, and that is the number that we use to calculate the spending policy off of. So in a rising market like we've had, we actually are spending less than 5% of the current balance of the fund, right? Mm-hmm. So, you've got a nice up and to the right line that you're working on. You could take it at that very tip, but if it drops as it did in 2008, pretty substantially, you're going to be really impacted by that drop. With a 36-month average, you've smoothed that number out over those 3 years, and allows a more consistent distribution into the community. It can delay some of the the aspects of in a very strong market like we have, but it also means that in March, I was able to tell the board of directors and all of our donors that their spending policy, even if we dropped a further 20% from where we were that day, or where we were at our lowest, if we dropped a further 20%, we would still have about the same distribution amount as we had previously, because we had delayed paying out on the prior increases in value, and 2019 had been such a fantastic year.
Mm-hmm. So taking these components, when you're speaking investing, you're speaking about long-term investing. It's important we make that.
Yep.
When you talk about your donors throughout 2008, a very difficult market time, money was still coming into the fund. And to tie that to individuals who might be listening, that's the same as putting that paycheck in each week, not,
Absolutely. Yeah. I mean, and my 401k, I still contribute to it on a monthly basis, right? I actually like the fact that, well, first of all, it's automatic, comes out of my paycheck.
Yep.
But it doesn't, I don't even think about it if the market's going up or down. Like I said, if it goes down, that just means that I'm able to buy in at a lower valuation than I did the prior month. And I still have, I've got another at least 10 years, I hope, until I retire. So, in my mind, that's still a pretty long time.
And Jonathan, as you're even taught in spending policy, the money going out, you're still making your contributions, your charitable payouts could be the same as us as individuals, needing to pay ourselves a little. But as we're talking, there's no panic in your voice. There's very little emotion. And you just casually referenced 30% stock market drops.
Yep. Well, I mean,
the media was not calm in either of those situations.
Well, and in some cases, our donors are upset, right? They've just given us money and they've seen it lose value, and they had goals that they wanted to give that money out, and we've talked to them about that. We actually had made some changes to our own structure. In 2008. When that occurred, we actually hadn't segregated what we call our spending policy from the investment portfolio. In 2008, I oversaw the formation of what we call our grant-making fund and our intermediate fund, both really in recognition that our donors, when they give us money, have a shorter time horizon, like I said, they want to give money next year, or as soon as they give it to us, they want to turn around and put it out the door. So our grant-making fund is effectively like a money market fund. Right now at the balance is, it's the beginning of the year, it's about $60 million. It'll be spent down throughout the year to slightly below 30 million.
So right about that 5% number you mentioned earlier.
Yep. So that sits in cash and is ready for us and our donors whenever whenever the money is to go out the door. The intermediate fund has what we call a time horizon of 3 to 7 years, which is the expectation. During that time, you might see a loss, and it's got more market exposure, but it's still, for growth. But within 3 to 7 years, at the very least, the principal will have been earned back. We've actually been pretty successful with that fund, just because of how it's invested in very liquid equities and mostly fixed income assets. So it's kind of the reverse of our perpetual fund. And that has performed very well throughout this period of time.
And Jonathan, you have a plan. This isn't just an arbitrary 6%. It was directly correlated with the 5% spending policy. You have a plan to grow the other assets.
Yeah, I should probably talk a little bit about why 5%, right? So that's become a rule of thumb in the institutional space and for perpetual funds. It basically is deemed to be the amount of distribution you can make on a perpetual basis from a portfolio and still make it back, right? So on an annual basis, it's funny, the way I think about wealth these days is if I had $1 million, I feel pretty confident I could take $50,000 a year out of that $1 million and in perpetuity take that as a cash stream. right?
That's assuming that $1 million is invested or under your mattress?
Invested, right? It's got to have market exposure. Maybe we can talk about that. Just because the other component of our spending policy or our target, I should say, is that inflation. That's really to ensure that that 5% today is worth the same in 10 years, say, right? So we want to make sure that we're tracking with inflation because, I hope everybody who is watching understands that $1 today is worth more than $1 tomorrow because inflation just eats it away, right? We've been fortunate. For the most part, inflation, as it's officially measured, hasn't been impacting us. There's a lot of deflationary pressure, not least of which is technology. My cell phone has more power than my first computer, right? Mm-hmm. And that's a deflationary pressure. But the reality is, the first iPhone, I think, was about $500. Current iPhones cost, the top line $1,300. So that is another type of inflation, right? So you're going to want to get the latest iPhone, right? If that's the case, you want to make sure that you're keeping track and the ability to do that, right? So hopefully that $500 is now worth $1,300.
There's some important analogies to unwrap. I hope that my students from Pitt are zeroed in right now because one, the importance of inflation. If you are not investing, the spending power of that dollar, you don't have a chance of keeping up with it. Dollar data is worth less in the future. I loved the analogy where you said, if I had $1 million, I would have confidence if that was invested that I could pull $50,000 a year, be it salary, living expenses, and have confidence in both the investments and that $50,000 being there. Those are such important concepts to get in the minds of individuals also.
Yeah. And so that's really our, kind of the philosophy that undergirds our whole approach.
You've put some slides together, Jonathan. Do we want to, is now a good time to dive in and just show the listeners, the viewers, kind of a behind the scenes snapshot?
Sure. So, I may be the staff person who leads the investment office. But I am really my boss, outside of the boss of the foundation, Lisa Schroeder, who's our president and CEO. My boss is the chair of the investment committee. I don't know if do I have control here to do that?
You do, yeah. There we go.
Right, there we go.
Well, I kind of like where you're going with this statement. I apologize for interrupting, but it's ultimately the boss. It's the goals of the organization, right? The investors.
Absolutely. Right. So, unlike a for-profit company, a nonprofit is really doesn't have shareholders. So the people that really tell us really where we get our marching orders from is from our board of directors. They are trustees of our nonprofit, and they form various governance committees underneath the board of directors. There are two committees that I directly interface with. One is the investment committee, and that's where that really drives the investment program. And some of them are members of the board of directors, and some of them aren't. Right. I have the great fortune of working with a fantastic committee that are all professional investments, and I should say investors, so involved in the investment industry. And then we have an audit committee that oversees the work of the whole foundation, including the work of my staff and the investment manager. So the audit committee and the investment committee together provide oversight over the various people involved with the investments. And so if you go down one level, we have the investment staff, and like I said, it's investment and accounting staff, I should say, because I don't want it to certainly not miss them. There's a lot of work that happens on the operations side to ensure that when we receive money in, it goes where it should be in the portfolio it's meant to be, and any changes in value are accounted for.
Like that, I'm sorry? That's where you are in this picture, right, John?
That is correct. That's correct. So I guess right in here, right? So in addition to that, because for a couple of reasons, a staff of 4 on the investment side overseeing $1.2 billion is a lot, particularly when it comes to the selection of managers within those portfolios we ourselves manage. So we have actually hired and worked with a consultant. The consultant we use is actually Pavilion, which is a subsidiary of Mercer. And we get access to their staff, right, and their expertise. So, if there's a particular question we have, we can turn to them, someone who has a deeper expertise in that, and we don't have to hire that person internally, and we can kind of get it at scale working with our consultant. Similarly, we have as a nonprofit where we are. Well, we're not required to, but it's certainly best practice to have an external audit. So we have an annual audit that validates our processes as well as validates the values that we report on our financials. So we work very closely with the auditor and the audit committee. But ultimately, that money, we don't select any specific assets ourselves, right? We are actually hiring investment managers to do that. The only exception to that is if we decide to implement an index strategy and we purchase an ETF. In the past, we have purchased individual bonds, but that gets more complex on a larger portfolio, so we don't do that anymore now. So
that's important, Jonathan, and timely, because just dating our conversation, we're in the midst of the GameStop, the AMC conversation, and you're buying portfolios, you're buying diversification, it sounds like, which is many.
Right. Well, and I really, the where we spend the bulk of our time is on, is asset allocation, right? There are a number of studies that have shown that 85 to 90% of a portfolio's return is determined by asset allocation, not individual security selection. Right.
Well, isn't there another 85% of us lose money if we try to trade individual stocks? So there's
well, there's that.
Could you define asset allocation for anyone who maybe has never heard that term but says, wait, that sounds pretty good. If 85 to 90% of the Pittsburgh Foundation's investment return is coming from asset allocation, I should know what that means.
Yeah, well, actually, before we get there, let me just finish talking about the structure just for a second. So when at the bottom, and I've mentioned trustees as our board of directors as a group of trustees, there's also trustees that we work with for trusts of which we are the beneficiary, and that would be BNY Mellon and PNC. But we also work with local investment advisors as well as investment managers that we ourselves select. But ultimately, the assets themselves are held at custodians, right? So that's really the bottom layer. We actually do invest in individual securities. We just don't select them ourselves, right? So we delegate for a total portfolio to a local investment advisor or trustee, or we delegate a very small slice of a portfolio that we manage to a specific manager who themselves selects individual securities. So I have a way to report and figure out, do we have any exposure to GameStop? Yes, I can guarantee you we have exposure to GameStop. Do I really care? No, because it's actually a very small slice of the total portfolio.
Well, that's interesting, and everyone listening probably just do you still have the exposure to GameStop?
I'm sure I do, partly because we utilize index funds in a number of our portfolios, and so those index funds hold components of it, right? Additionally, and that would be maybe a less valuable because it's passive. They're going to ride with the market. But we do utilize active managers that may have held some portfolios. We actually utilize a quantitative manager that I suspect was holding GameStop maybe for shorter periods of time. But that's just the way of the landscape. So if I
don't want to go on. Before you go to the next slide, I have 4 questions, but I don't want to interrupt again. So keep going. Give me the thumbs up when.
Okay. So you asked about asset allocation, and that's really where the meat of the work that we do comes in, right? This doesn't change. It changes actually very infrequently. But it is something that when we were first designing our portfolio, this is where we spent a lot of time. What do we want to look at? So there are, these are 5 very basic categories of investments that pretty much any portfolio that we look at is going to have some component, some exposure to. So this is our target, what we call our target asset allocation. And when I talk about rebalancing, this is what we're rebalancing to: the equity exposure, the fixed income exposure, real assets, and diversifying strategies and cash. So our target for this portfolio is 0% to cash. That's not because we don't like cash. We get cash in. This portfolio holds cash for periods of time, but we don't really want to have cash because it really does not add value to the strategy that we're trying to achieve. The base component of this, and the largest component, as you can see here, is almost 60% equity. That's going to drive the growth of our portfolio. We all know that, well, maybe we don't, but over time, an investment in equity is the best thing that you can do. It's going to have the best return over a long period of time. You're getting, the equity of a corporation is really where you can get the most return. The fixed income, but the problem with equity is it can be very volatile. As we know, we've seen just this past year, like you said, a 30% drop in local equity markets, actually across the board, internationally as well. So, how do we dampen that volatility? We actually then use fixed income for 2 reasons. One, it should provide a steady source of return. Unfortunately, fixed income interest rates at below 1% or around 1% for 10 years, that's not going to get us to that 5% return, let alone inflation adjusted. So we've deprecated that importance over time, as you'll see. But it does have a very other important part. It is the anchor to the portfolio. It's called a deflationary hedge. When you experience serious drawdowns in equity markets, people flood to fixed income. They want to go to that safer asset class, which fixed income provides. And as a result, you'll see it'll increase in value. It's also the source from which we can actually derive our spending policy on an annual basis. So we don't have to turn to the volatile equity markets to liquidate assets in order to get that cash flow. We can actually turn to fixed income. The other component, remember, we have an inflation as a component of our goal. So real assets provide that inflationary hedge, right? So you've got growth in the center, you've got deflationary on one side, and you've got inflationary hedging on the other side, which in total helps us grow the portfolio over time. Lastly, the diversifying assets are really those that I would say are less correlated and are just offer different sources of return to any of the other asset classes, right? So we're looking for market neutral funds or macro funds, again, that should make money at any time when maybe equities aren't, or when real assets aren't, or when fixed income doesn't. So that's
asset allocation ties into a word we used just a short while ago, diversification.
Mm-hmm. Yes. So all of these asset classes, we expect to have different return profiles, different correlations to each other, and overall give us a longer, broader sense of investing. So the other, I'll just tell you, this is how we were invested as of the end of the year. And you can actually see, oh, there's that cash. It's at 7%. Because at year end, that's when we receive, I think in the last month of the year, we receive about 70% of all donations. It's because happens to be like when we, for tax consequences at year end, we, as a public charity, people use us as a way to defease their tax bill. And you can see also that, our real assets have shrunk. Again, this is because inflation has not been an issue, so we're less concerned about it. As well as fixed income itself has become less important, right? So again, the bulk of the portfolio is being driven by equities. It's where we expect expect to have that return in the future.
So Jonathan, it shows a little bit of flexibility versus the prior chart, the target policy versus the actual markets move. Stay calm throughout.
Absolutely. So then the last slide that I just wanted to show around asset allocation is just how it's changed over time. And you can see, it does fluctuate and it has changed. Like at the start, we had 10% in real assets. At the end, it's about 6%. We had about 10% in fixed income. It's now about 15%. Some of that is driven by the different underlying strategies that we've used that we haven't gotten into. People talk about hedge funds and private equity as alternative sources of return. We actually do utilize both of those in our portfolio, but I don't know if we have time to get too deeply there. The only comment that I'll make about hedge funds is they're not an asset class. They're actually just a structure, an investment structure, one that's allowed to go short the market somewhat maybe exclusively versus one that is a long only mutual fund. And private equity is the importance of private equity to institutions is that we have such a long time horizon. We can use what is or we can try to attain what is called the illiquidity premium. That is, there is an identified premium for investments that last for a long period of time, right? You can actually earn more than you can with public markets that have a shorter duration and a shorter time horizon. So,
John, I want to tiptoe around a question here because when you say hedge funds in that light, the hedge funds that are managing assets on behalf of the Pittsburgh Foundation are earning money or a part of a bigger picture to earn money for these 2,400.
Absolutely.
So there's good. And that money's ultimately going into these charities, into these social causes, into these areas of need.
Yep. I have the benefit of working in the investment field, which I absolutely love, trying to figure out how to do this better every day. Knowing that what I'm doing is actually accruing to the community and the need within the community. So I'm extremely fortunate.
And the authenticity in your voice, it sounds like a dream job.
It is. So I was asked once, would you quit your job if you won the lottery? And I said no. So
powerful.
So that's really around asset allocation, kind of what I was interested to talk about. I don't know if there's any you said there were questions that were coming in. Maybe we should answer those.
You addressed a great question that came in from one of our students. How do you balance earning a return on the foundation's portfolios while also having enough money? I think you hit that pretty effectively with that equity fixed income asset allocation.
Yeah. So specifically though, again, I go back to, we segregate our assets that are short-term in nature, right? That we see as either our donors have identified or we have identified that are going to go out to grantees in the next 0 to 2 years. We segregate them in the lowest risk portfolio that we have, our grant making fund. So it has, its goal is capital preservation above all else. And when interest rates were really low, we were earning 10 basis points a year for holding cash. That can be depressing.
Well, for anyone not
you think about how little money $6 million can earn in a year for 10 basis points. However, this past year and the past couple of years, we've been earning a couple % on that portfolio. So it fluctuates.
And for anyone unfamiliar with basis points, 1 basis point is
of
1%.
Right. Right. It's a very small number. 1 basis point is a very small number, even on $60 million.
Jonathan, can you jump to your final slide? Because I have seen your presentation beforehand.
Oh, yeah. I had forgot about this. So this is actually one of my favorite slides. It shows the asset values of the foundation From our founding in 1945, it actually appears to be zero. I think the first year our assets were about $2 million, up through 2019. So these are all based on these are numbers that are based on our annual reports that we publish. That lower darker line, an area graph, actually shows the value of the assets, our total foundation. So this is not just the invested assets, it's also fixed assets and the underlying supporting organizations. But the reality is the bulk of it is actually investments. And that top lighter area is what we call, or is the cumulative grants. So the grants in total that have gone out the door added up over time. So it's almost double what our total assets were at the end of 2019.
Jonathan, so let's say it's 1957 and we've changed our mind. You and I, if we are the donor at that time, could have said, I've changed my mind. I'm going to just retire, live happily ever, and spend all this money. And no one would have blamed us. Instead, look what happened. That's a giant number of cumulative grants.
Absolutely. So there's two things at work here. One is the compounding effect of that. We're only spending 5% of a 36-month average. So it's less than 100. It's much less than 100%. It's less than 95% tip in any given year of what the total assets are. Mm-hmm. And we're also gaining new contributions, right? So there's an additional aspect to this that Pittsburgh is extremely fortunate to have had the leaders in the community that started a community foundation back in 1945, but also along the way, the donors and families that have stepped up and donated assets to the foundation for the various causes that we support. The other thing I'll say is, as a community foundation, we truly do represent the community. I almost unequivocally, I would be shocked if 99% of all nonprofits did not receive a grant from us, right? So sure, there are some nonprofits that haven't received a grant from us, but by far the vast majority of nonprofits in the Pittsburgh community and the broader region have received grants from the Pittsburgh Foundation, and that's just a testament to our donors. That's not us as a foundation, but that's the vision of our donors in setting up funds with us.
It's a powerful statement. When I see this chart, I think investing is a long-term relationship, and it works if you stick with it.
Yeah, absolutely.
We've got a bunch of questions in the queue, Jonathan, but I want to tighten up on. I just took 4 notes to maybe this will kind of rapid fire so we get to the questions in the queue. You had mentioned the word custodian as part of the big picture. Mm-hmm. For anyone unfamiliar with that term, what is a custodian? What is the role of the custodian?
Yeah, so the custodian actually holds the legal record of the investments that we have, right? So for example, back in the day when they used to issue stock certificates, and this is really how custodians arose, we as particularly for a bearer bond, right? For those that you don't know, a bearer bond, if you hold it, you can actually, there's a little coupon that's attached to it. You would cut that coupon off and send it in, or go to the bank that had issued the bond and get your interest payment. As an institution, we wouldn't want to hold that, right? I would keep it in my desk. Somebody could come in and take it. So what a custodian does is they actually securely hold those investments, right? Those assets are now called securities. So in the present day, really what they do is they hold the legal title for us and work with all of the other service providers that allow or that notify, that GameStop, that we actually own 10 shares of GameStop. It's held by the Pittsburgh Foundation in one of our custodial accounts that one of our investment managers works with, right? So they're a service provider, but a very critical one to ensure the seamless transition, in case For example, I get abducted by aliens. I prefer abducted by aliens than being hit by a bus. I might come back. So if I get abducted by aliens, there's still somebody can work with a custodian to ensure the proper administration of our assets.
That's important. So when you mentioned hedge funds or Vanguard, it's not the hedge fund or the Vanguard that holds your assets. It's that they're safe in a custodian.
That is correct.
Vanguard invests them, directs the investing.
Right. And we work with, and that's the case for mutual funds as well as individual securities or bonds, right? Or ETFs.
Excellent. Just two more, just quickly on the investment consultant. You mentioned consultant. What does your consultant do?
So our consultant, we work with them. They have experience with, they've made investments in modeling software, so help us determine, different scenarios in a certain circumstance, right? I mean, I've run Monte Carlo, which is an analysis of potential outcomes, statistical analysis of potential outcomes for a portfolio. It's very tedious. They have the software that helps do that. So when we're doing asset modeling and we want to know what the correlations are between asset classes, they help us kind of figure out, maybe optimize where we need to be. They also track most of the universe of investment managers. I say most, it's not all, but they have exposure so that if we're doing an investment manager search, we can turn to them and help us cull down from literally tens of thousands of investment managers down to maybe the 3 or 4 that we would want to spend time looking at and talking to, right?
And they don't actually touch or manage the money. They're that independent voice.
Correct. And they help. They provide good advice to the committee. They also do macro research around or economic research, I should say. So if I need, I'm looking for data regarding a specific economic outcome, they can provide that, or a particular situation. Additionally, they help just from the standpoint of underlying operations, right? So there are a number of legal agreements that we sign in regard to our investments, so they help us, manage that and complete them. Again, they're an extension of our staff. There are any number of institutions that don't work with a consultant, and all of that work would have to be done internally. So we'd have to hire people to do that, and it's certainly reasonable at a certain scale, but at our scale and complexity, it is extremely helpful to work with a consultant, and it is just more cost effective.
And independent voices are always helpful in a conversation.
Mm-hmm. Absolutely.
The last, there was more just a note I wrote down, was that you'd mentioned index funds, which they own all the companies in a pre-specified index. Mm-hmm. With GameStop, it's interesting. BlackRock, Charles Schwab, Vanguard are 3 of the largest owners of GameStop, and none of them did it. Not surprising. GameStop was worth more than company XYZ. It's because GameStop was in an index. Right,
and if GameStop had retained its value, right, at its peak, it would have become a much larger holding in all of those funds. They would have had to go out and buy them on a regular basis, right? So one of the things that an index provider is doing is managing that exposure, particularly in a volatile, in a volatile stock. They'll still try and do it, but it's going to be, when it's as volatile as GameStop was, I imagine that they're not going to closely track it as much as if it was. Even Tesla, which is still had a good run last year, but has maintained its value, relative value, more than GameStop.
That leads well into some students who submitted questions beforehand, Jonathan, when they heard we were having this conversation. The first is, in a world where investing is becoming more accessible, are we going to reach a point where it becomes too accessible? Is last week, if I framed the question that have we reached that point?
I would say that it's never too accessible. I think, the question can become, when you get into manias, I think it's more about education and understanding what you're buying, as with anything, right? Having a driver's license and getting access to a car, everybody should have access to transportation, regardless of who they are. We just want to ensure that they know how to drive a car, right? they can cause damage to themselves or to others if it's not operated properly. Similarly with investing, I think that's maybe a little too glib, but I do think that investing should be available to all. There are certain aspects of investing that I think have been appropriately mediated. When you talk about options and like the ability to purchase a potential call on a stock or put on a stock, I think those can add leverage, very strong leverage to a portfolio and lead to great gains, but also if employed poorly, significant losses on a much larger scale than anybody really should be doing without a lot of education. I mean, the one of the most important things that I've heard is you should really understand what you're investing in. If you don't understand it, if you truly don't understand it, you're speculating. And so speculating is a lot like gambling, right? If you don't have a clear view of why you want to own a stock, and understand how that corporation makes money, I think then you're really erring on the side of speculation. So, one of the concerns that the important long-term, I'm looking at this question here, the important long-term implications of the rise in retail trading and Reddit stocks is more that there is this, people are buying because other people are buying, right? That not necessarily, and that there are things called, there's a factor called momentum, and that can be a positive force in investing. But that's, you don't want to buy a stock just because somebody else bought it. I speculate in the, with GameStop, it's being classified as a short squeeze or even a gamma squeeze, which we won't get into. But when a short squeeze, what you're doing is you're trying to force the people who are short the stock, who have sold it, to have to cover their positions by buying the stock, and that causes the stock to increase in value, right? So if you're involved in that, what you're really looking to do is at some point, if it's done purely, right, you force them to cover their short by you buying the stock. They've got to buy it back, so they're buying it back from you. But oftentimes in this, what happens is it runs up a lot higher, as it did with GameStop. I think at one point it was over $500 a share.
Yep.
If the person who was on the other side of that trade was not covering their short, that means they were long. They were going long at $500 a share in GameStop because other people thinking that they were going to join this train ride to the top. Nothing goes up forever. So somebody was on the other side of that trade, bought at $500 a share, and is now sitting on a loss of over $400 a share. And that's
painful lesson.
If they did it because their neighbor was doing it, mm-hmm. Right? So I don't. To go back to the original question, I think I don't think it's gone too far. I just think this is education, and hopefully people didn't get hurt. I think I have concerns about the gamification of trading that Robinhood has done, but there's an aspect to that it's really, there's some good education there too. So I'll get off my soapbox.
Well, you lead well into our next question, because you so calmly talked about events like 2008, March of 2020. How do institutions take away the emotions of investing that individuals face? What lessons could an individual take away from that calmness?
Well, so partly is having a plan, right? So if you're putting, again, I talk about, we have our perpetual fund, our legacy fund, and we have our grant making fund, right? That grant making fund is for cash for those grants that we're going to be making in the coming year. And the legacy fund is that long-term portfolio. I would be more concerned. I was really concerned at the time, like I mentioned back in 2008, about money markets seizing up. If that was the case, then I'd be really concerned about our grant-making fund and the ability to actually pay bills. But that wasn't the case. That turned, there was enough supports put in place. So then it just became a normal market correction. I knew the legacy fund, or the legacy fund didn't exist at the time, but I knew our portfolio was going to drop in value. So one of the things that we do is we actually segregate our assets into time horizon portfolios so that we're fully aware that, in the short run, these assets could drop in value, but in the long run, they will be greater in value. Whereas our other assets, the ones that we need more immediately, are protected. So the learning you can take from that is don't, put at risk those assets that you need in a short-term manner.
Have a plan and understand where you're putting that money to work.
Absolutely. Right. So to that point, and the way we codify that as an institution, I mentioned it earlier, was our investment policy statement. The investment policy statement is something that, we as staff, we work with our consultant and the investment committee to agree on for a specific portfolio. It has a goal. It has that goal then drives the underlying risk assumptions. And then those risk assumptions drive the underlying asset allocation, right? And then altogether, everybody, this is basically the plan that we reference all the time on a regular basis, like that target allocation that I showed earlier, that is derived entirely from our investment policy statement.
Institutional.
So it's really about, we go back to, I'm sorry.
So an institutional investment policy statement sounds a lot like a financial plan for an individual.
Absolutely. Yeah. I mean, we have one added benefit that individuals do not have. And that, as a nonprofit, we don't face taxation for our investments, right? So, we can be very short-term in nature. We don't have short-term capital gains or long-term capital gains. We're actually the beneficiary of that because our donors can donate appreciated stock to us without having to take a step up in basis and incur a significant tax bill, and yet get a full write-off on their taxes for it. But that's just a nuance of that. But it is very much like a financial plan for an individual. I mean, an individual, if they work with their financial advisor, should also have an investment policy statement that their investment advisor is working from. That's also part of it, right? Again, it's a plan on how to actually invest money that correlates risk to understood investment or asset classes that everybody is on board with, right? Whether that's, something as benign as a bond or something as esoteric as art. There are some investment policy statements that invest in art. We don't, but there are some that do.
Jonathan, I like that question. I'm going to jump back to the one that was just on the board because I liked it, and I think you probably like it as well. What, in your opinion, is the most underrated piece of financial advice for young investors? Let's delete investors, just say individuals.
Yeah, you'll hear it all the time, but compounding returns or compound interest is a very, very powerful thing. I mean, that last slide I showed demonstrates it. But it seems to take forever, right? I don't know if anybody has an investment account, you're working with it and it's going up in value, but it's not going up as much as you want. But if you look back over a period of time, I mean, I'm, 55. I remember when I received my first share I received a couple shares of Procter & Gamble stock. My grandfather worked for Procter & Gamble. And so it's kind of a part of our family at this point. And, it was worth about $1,000 at that time. It's now worth quite a bit more than that. And it's something that I feel very, because I didn't do anything with it, right? I just sat there and held it. I reinvested the dividends. So all of that money has continued to compound. The dividends bought more shares of that stock, and it's just been phenomenal for me. That, and I also started investing in my 401k as soon as I could, and as frustrating as it was to see it be very small when I was in my 20s, it's now something that is I feel is an important part of my retirement plan.
Fireworks again, right there, because that if you stick with it, it works.
Right, and that can be very hard. You're young. There's lots of demands. You start to have a family. You want to buy a house. You have kids. You want to send them to college, but that persistent effort will pay off in future, just future sanity and discomfort.
In a world of the pursuit of instant gratification, it's so difficult but so important. Jonathan, I like this final question. What would you say are some of the biggest differences between working for a nonprofit versus a for-profit? You have experience in both.
Mm-hmm.
Don't feel any pressure to answer the second part, which do you prefer?
Well, again, I've had a long and varied career. I've worked for a number of different nonprofits or different for-profits, not just in the finance space. There is a more immediacy to it. I mean, the benefit of working at a foundation and institution is it does have that longer term focus. It has the same pressures that you have in a for-profit space. I think to be perfectly honest, what happens within a nonprofit, and foundations are unique, or the community foundations are unique in that aspect. Nonprofits themselves face so many pressures from regulation and need, and just a constant need to get money from donors that may not understand the underlying operating complexities of that nonprofit. So they push the organization in different ways, that maybe have it stray from its mission. So it can be much tougher, I think, to run a nonprofit than it can be to run a for-profit. For-profit, relatively straightforward. You make your customers happy. You give them a good product. You're going to make money as long as your operations are in order. With nonprofits, your customers, your clients are actually maybe the beneficiaries of somebody else's generosity, right? So they're not necessarily choosing to purchase from a nonprofit. The nonprofit itself has actually got to go to people who have wealth, philanthropists, or people like the Pittsburgh Foundation, convince them that what they're doing is good and effective. And that's a tough, very tough process. Fundraising, the people that are good at it, I take my hats off to them because they're amazing people. And then the people who work in nonprofits, it's utterly, it's 5 times more complex, I think, than a for-profit business, because of those differing factors. And yet, I prefer the work that I do at the foundation.
That is very apparent listening to you, Jonathan.
The other aspect that's different, pay is often less within the nonprofit space. I think it's unfortunately erroneous, because it's a false dichotomy. But that's just the way it works. In order to achieve your mission, nonprofits often face a lot of different pressures and have to, in a lot of ways, I'm going to get on my soapbox again. There was a commercial that showed a woman who was approaching retirement saying, "Oh, what am I going to do in retirement? Oh, I think I'm going to start a nonprofit." That has got to be the hardest thing you could possibly do, to start a nonprofit. It is much harder to start a nonprofit than it is to start a for-profit business, right? Because if you're going to start a for-profit business, you have a pretty good idea that someone wants to pay you for it. If you want to start a nonprofit business, there's a need that you're looking to fill. You're not even sure anybody wants to fund. Mm-hmm. So, again, I'll get back off my soapbox, but that demonstrates in my mind, the complexity of running a nonprofit.
We could look at someone in your role or the work that the Pittsburgh Foundation does and say, boy, that's easier. I wish I could do that. And it's anything but. It's a ton of hard work.
I work with some amazing people, that do a lot of amazing work. I mean, that are really dedicated to the task of, identifying the need in our community. And there is some stark need, particularly these days, with literally millions of people who are unemployed now that weren't this time last year. All facing, a circumstance, or nonprofits are facing a circumstance where giving is lower, and need is that much higher. So, I don't know. You're right. It's not easy work. So.
Well, Jonathan, as we prepare here to wrap up, I like to use the word humanize, and I don't mean that in any negative context, but, here you are, we're talking casually about the $1.2 billion foundation you manage, which is not a small amount of money. I'm curious, what was plan B? So if you weren't, here investing these assets, would you be an astronaut? Or what was?
Well, oddly, that was what I went to Carnegie Mellon for. I went to CMU as a physics major with the intention of pursuing that dream of being an astronaut. I realized
I didn't know that astronaut part.
I realized fairly quickly that that was not what I wanted to do. But Carnegie Mellon was a great place to be, and I ended up pursuing a degree in finance with a focus on investments. Ultimately did that for a period of time. I worked in community banking and mortgages for a period of time, but really was not happy with the way my career was going there. Because I'd been at CMU, I'd had a lot of exposure to computers, and it'd always been a hobby of mine. So I ended up working with a local friend and worked in the computer industry, essentially in the internet space, and kind of rode the internet boom for a period of time, and the technology boom for about 12 years. I actually worked at a startup here in Pittsburgh. When that 9/11 happened, our actual the investments ran out, and we ended up in the tech boom of 2000 really was in full force at that time. Took a look at my career and what did I want to do, and I decided I wanted to get back into the finance field and specifically focused on investments. So started pursuing the CFA degree at the time. So you could say that this is in some ways plan B.
Fortuitous.
But it was, I happened to just be in the right place at the right time. I mean, extremely fortunate. I was doing some consulting work for the foundation, ended up leaving and working at Mellon in their securities lending. As I said, this was around just before the financial crisis. Like I said, I was doing credit work on reinvesting cash for the bank in regard to securities lending, which is a very unique and interesting part of the business that if you ever find me at a party, I'd be happy to describe it to you. But then had the opportunity to come back to the foundation essentially for what has become this role, because they knew who I was and what I was interested in doing, and they were looking to bring kind of focus to the investment side of the business. So, there's an aspect to right place, right time, but there was a lot of hard work leading up to that. I was actually thinking back on the work that I did at the bank. It's retail banking is can be interesting if it's the type of work you want to do. But I learned a lot of lessons about businesses, about personal finance there, just by the customers that we worked with. It was a very interesting time, and the same with the mortgage underwriting that I did. That helped me later on in my career when I was working as a credit research analyst at Mellon, because we were aggregating those mortgages that I had worked, not those specific mortgages, but the same concept. We were aggregating them in the investments that we held, and I could see the cracks in the system already. I mean, I knew that mortgage underwriting standards had completely gone out the window at that time, and recognized that that was a potential risk that was going to happen. So, you pick things up throughout your career that I think ultimately help you. My exposure to startups, and the technology space has helped me as I look at venture capital investments that we make, right? I understand a lot of the underlying technology that those venture capital managers are talking about. So it's all kind of come full circle, I guess. Being a portfolio manager, you really have to be aware of the economy, how corporations work, how the nuts and bolts of investing, as well as why a donor wants to give you money, right?
Mm-hmm.
So
hard work is a good formula, and your passion just shines through, Jonathan, both for the industry as well as the work you do. Candidly, I've been imagining you with an astronaut hat ever since you said you wanted to.
I always said I wanted to earn enough money to buy a ticket, right? In Virgin Galactic. So I don't think that's going to happen, but it's still, a man can dream.
We're getting closer. Jonathan, let me say thank you. This was just fun. This was insightful. I appreciate your time. I'm proud to know you, and just keep up the great work that you're doing.
Oh, no, thank you. It's been a pleasure. Thanks for listening. I think the organization I work for is a great institution, and hopefully has had impact on at least one of the people that are your students. So it's
no doubt about it. I guarantee it. Yeah.
Thank you, Gene.
Thank you, Jonathan.